So today I'll be sharing a little bit from my research on how traditional credit scores may be a barrier to accessing affordable credit, as well as some of the solutions to addressing this barrier. Before I begin, just a standard disclaimer that the views expressed here are solely those of my own and do not necessarily reflect the views of the Federal Reserve Bank of Kansas City and the Federal Reserve System. So as Irene mentioned, access to affordable credit is vital to consumers' economic well-being. Consumers can, with access to credit, consumers can better manage their finances and cope with emergencies, as well as to pursue opportunities such as higher education and entrepreneurship. And traditional credit scores in the US plays like a very major role in determining who has access to credit and the cost of credit. Most lenders use the scores to determine whether to approve a loan application, as well as the interest rate to set for the loan. Now, the advantages of using traditional credit scores for assessing consumers' creditworthiness is that it provides lenders with a standardized metrics for objectively, consistently, and cheaply evaluating consumers' creditworthiness. And this allows lenders to process more credit applications. The credit scores are also generally predictive of default risks. So they do provide lenders with some useful information about consumers' creditworthiness. However, the challenges with using traditional credit score and access to credit is that not everyone has a credit score. So about 28 million US consumers are credit invisible, which means that they do not have any kind of credit history. And another 21 million are unscorable, mostly because their credit history are too short to generate a score. So in total, about 49 million US consumers have no credit scores. And amongst those who have credit scores, about 57 million have subprime credit scores. So this is a FICO score of lower than 620 or a Vantage score of below 600. And many lenders do not lend to consumers with subprime credit scores. And when they do, they charge a significantly higher interest rates to this consumer. Based on my calculation, using the 2019 survey of consumer finances, about 11.6% of consumers did not obtain the credit they desired in 2019 because they lack because they either lack a credit score or do not have high credit scores. So more critically, a lot of consumers who are not able to access credit because of their credit scores may actually be credit worthy. This is because the predictiveness of traditional credit scores, which are derived solely from consumers' credit bureau data, is going to depend on the availability and the quality of credit bureau data. Credit scores tend to be less predictive for consumers with thin files or noisier credit bureau records. So these are consumers, for instance, who have past delinquencies in their records. And some consumers, as a result, some consumers may have no or low credit scores even when they are credit worthy. Consequently, lenders' reliance on these traditional credit scores may actually lead to an inefficient denial of credit to some of these consumers. One group of consumers who may have low or no credit scores, even when they are credit worthy, are those who are younger. And these are consumers who are new to the credit market because they've only very recently entered the credit market for the first time. Many of them do not have any kind of credit history, or they have a very short credit history that's not sufficient to generate a credit score. Even when they have a credit score, they tend to have younger accounts, shorter payment history, lower credit limits, and so on and so forth. All these are factors that result in lower credit scores based on the traditional credit scoring system. So this would be, they would tend to have lower scores regardless of their true creditworthiness. And another group of consumers are the low and moderate income and Black or Hispanic consumers. These consumers tend to have some kind of disadvantages when they are trying to get their credit history started. So many of these consumers come from communities where there are fewer opportunities for them to piggyback on the creditworthiness of others, for instance, by having a co-signer on their loans or being added as an authorized user on somebody else's credit card. And as a result, they tend to be credit invisible for a longer period of time. Further, they are more likely to have their credit history started as a result of a derogatory event, such as a bankruptcy or third-party debt collection. As a result of that, many of them start off at lower credit scores compared to their higher income and white counterparts. And research have shown that credit scores tend to be very persistent, and consumers that start off with lower credit scores tend to continue to have lower credit scores, even after their financial circumstances may have improved. And consequently, they may be more likely to have a score that is less reflective of their current creditworthiness. And we can see here the data suggests that younger consumers, Black and Hispanic consumers, as well as consumers living in lower income neighborhoods, tend to have lower credit scores on average compared to their older, higher income and white or Asian counterparts. And the fact that they have lower credit scores have implications on their ability to access credit. This chart here shows the share of consumers that desired credit by age, income, and race and ethnicity. So about 60% of consumers desired credit in 2019. And of these consumers, the blue bar here represents those who desired credit but did not apply for credit, either because they did not think they would get approved or because the interest rates are too high. And the green bar represents the consumers who applied for credit, but they were either denied credit or did not receive as much credit as they had requested. And the orange bar represents the share of consumers that applied for credit and obtained the full amount of credit that they had requested. And we can see here that the disparity in credit access across race, income, and ethnicity group, and age group, reflects the disparities in credit scores across these three groups as well. We can see here that lower income consumers, younger consumers, as well as Black and Hispanic consumers, they are more likely to have unmet or undermet credit needs because they either did not apply for credit or they applied for credit but was denied or was not granted the full amount of credit that they had requested. Very notably, these consumers are also the ones who may benefit the most from access to credit, since they are more likely to be liquidity constrained and they may not have the funds necessary to pursue economic opportunities such as entrepreneurship or higher education. And the lenders' reliance on traditional credit scores may place these consumers at a disadvantage for attaining credit, regardless of their true creditworthiness, and hence impede economic mobility amongst this group of consumers. So what are some ways that solutions to addressing traditional credit scores as a barrier to accessing affordable credit? Well, there are basically two camps of solution. Well, the more traditional camp of solution focuses on helping consumers improve their traditional credit scores. So these are products such as traditional credit building products, such as the credit builder loans and secured credit cards, as well as financial education initiatives and credit counseling. The newer camp of solution focuses on developing and using alternative credit scoring models. These are models that leverages alternative data or uses AI or machine learning techniques in predicting in generating credit scores. And at the intersection of these two, we have fintech credit building products, whereby fintech firms using alternative credit scoring model, they offer credit products to consumers that can simultaneously help them to build up their traditional credit score. So for today's presentation, I'll focus more on the newer campus solutions that focuses on the development and use of alternative credit scoring models. So let's look at first the use of alternative data. So what types of alternative data can be used in credit scoring? So basically any kind of information that is FCRA compliant. This could include alternative financial services data, rent and utility payment data, and other kinds of consumer permissioned data, such as bank account information, bank account cash flow data. And studies have shown that using alternative data can help to score more consumers and improve credit risk prediction, not only for consumers who have thin files, but also those who have thick files. Some examples of credit scoring models that use alternative data include FICO Score XD and Experian Boost. This models uses credit history combined with bill payment data. Ultra FICO uses credit history combined with financial account data. And we have also a few fintech credit scoring models, such as Cash Atlas and Cash Score. These are models that rely solely on consumers' cash flow data. In addition to using alternative data, lenders can also leverage machine learning to help improve their credit scoring models. Machine learning can help to uncover complex relationships between numerous data points. And research have found that the use of machine learning combined with alternative data by some fintech lenders have led to higher approval rates and lower interest rates for underserved consumers. However, there's a bit more of a lack of consensus when it comes to the benefits of using machine learning with traditional credit data. Some studies have found that machine learning can help to score more consumers. For instance, a study by Vantage Score has found that Vantage Score 4.0, which uses machine learning techniques, can help to score more consumers, and especially those who are in the economically disadvantaged groups. And however, others have found little to no benefits of machine learning for underserved consumers. There are also some concerns that machine learning may perpetuate existing inequalities because the data that is used to train those algorithms might reflect existing biases. Both the use of alternative data and machine learning is not widely, both of them are not widely adopted by mainstream lenders, in part because of the regulatory uncertainty concerning the use of this alternative data and machine learning. And more regulatory certainty is likely to be necessary in order to boost the adoption of these two forms of to encourage the adoption of alternative data and machine learning in credit scoring. So in conclusion, having low or no traditional credit score is a barrier to accessing affordable credit for many consumers, especially those in economically disadvantaged groups. Using alternative data or machine learning can help improve credit scores and improve credit scoring and credit access. However, adoption rates are currently low. Greater consumer awareness and regulatory certainty may help to promote the adoption of these solutions. So this is all I have for you today. Thank you.
Thanks, Ing. A couple of questions for you.
Yeah.
If we go back, well, you don't have to go back to, but on that disparities in credit access bar chart, there was a question around what is the situation for when they may not apply to credit? Is that over their lifetime? Is that a particular time frame, or is it for a specific purchase?
Oh, this is basically calculated based on the 2019 Survey of Consumer Finances. So this is during that year in 2019, whether people applied for credit for any kind of purposes.
Okay.
Yeah.
Okay, thank you for that clarification. And then I had a question around the credit scoring models, the alternative ones. Are the credit bureaus just starting to implement that? Do consumers need to ask that that model be used rather than the traditional one? How does that one get put into practice?
So for alternative credit scoring models, the use of alternative data, I think Experian is the one that is most familiar to most consumers. Experian Boost. It allows consumers to connect their bank account to their Experian account so that any kind of bill payment information can be picked up by Experian and used in their credit scoring model. And basically any kind of credit scoring model that uses alternative data requires consumers to opt in.
Okay.
So an Experian Boost only helps consumers Experian credit score and would not affect their credit scores, generated using Equifax or TransUnion data. So at the moment, there is no like overarching or like there is no how would I put it? There is like no automatic inclusion of alternative data into credit scoring models, and each credit bureau is doing their own thing.
Mhm.
And there's no like consistent practice.
Okay. So for like a consumer to opt in, I mean, do they just ask if they're going to buy a car and they're going to pull their credit, ask that they use that alternative model?
Um,
Or do they,
so like going back to the example of Experian Boost, the consumer
Mhm.
actually has to sign up for it prior
Oh,
to
okay.
making any kind of loans. And it only helps if the lender is pulling the credit score from Experian. So if the lender is going to pull the credit score from a different credit bureau, then it's not going to help
Right.
the consumer.
That is fair.
Yeah.
Um, I got another question around the how information's obtained, um, the data on how going back to that bar chart again, the disparities in credit access. You've got it up right now.
Yeah.
How is the information obtained, the reliable, where does the data come from on people that desire credit but did not apply? Do you have any, I think there's some interest in understanding a little bit more about where that information comes from. You mentioned where you got it from, but do you have any insight into where they receive that information?
Yeah. Okay, let me pull up. So it is I calculated this the statistics based on um a couple of questions that are in the survey of consumer finances.
Hmm.
Uh, one is that there's a question that asks consumers about whether they applied for credit in the last year, and if they did not apply, what was the reasons for not applying?
Hmm.
And for consumers who didn't I think I have to try to recall, but like I believe like some of the reasons are like the interest rates are too high, they did not think that they would be approved, they do not need additional credit, or they are not interested in using credit.
Hmm.
I can't remember what other ones there are. But as long as the consumers do not state that they are not interested in obtaining more credit, or they do not need more credit, I assume that those consumers have a desire for credit. And
Okay.
then based on that question, that's how I get the share of consumers who desire credit. And then based on that, I have also some information from the survey as to whether they actually applied for credit or not. And if they applied for credit, whether they were granted the full amount or if they were denied credit.
Okay. Thank you for clarifying that. Um, do you feel like some of the ethnic biases are kind of stuck in those algorithms that impact the processing or scoring? I mean, are you aware of any policies that are maybe out there to try and assist with that?
Um, are you like for the alternative credit scoring models?
I think in just how we assess credit scoring now, how currently LMI communities are more negatively impact, and those tend to be
Oh, okay, yeah.
Black and brown communities.
Um, I'm not aware of specific efforts to help address that. Like there are not specific efforts targeted at those groups of consumers. I mean, there are generally like solutions to help consumers improve their credit scores. But I think there is a general lack of awareness, even with the traditional kind of products such as like credit builder loans and secured credit cards. There's still like a lack of consumer awareness about those products and how to use them to help, improve on their credit score. So yeah, I wouldn't say that there are, at least I'm not aware of any kind of policies that are specifically trying to address that.
Okay, thank you. I've got another question. It's long, so I wanted to paraphrase it. I think I'll come back to them. There's a few in there that I want to get to. And I also want to make sure we give Mishu enough time. So why don't we go ahead and transition to Mishu, and then we'll come back and we'll finish the Q&A portion, if that works for you.
Yeah, that works.
All right. Take it away, Mishu.
All right. Thank you, Aaron. I was just trying to get my mic to work. So again, my name is Mishu, and I work for the Center for Indian Country Development at the Federal Reserve Bank of Minneapolis. And just a couple of words about the center. And the center is a National Research and Policy Institute focused on economic development in the country. So our work is primarily to advance the economic self-determination and prosperity of Native nations and these communities through actionable data and research that makes substantial contribution to public policy. So this is a research team that works essentially on native CDFIs at the center. And then of course, like Yang, these are my views and they don't necessarily engage the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So just to kind of give you some background information, I want to kind of follow this overview. First, I will briefly discuss the disparities that influence economic outcomes in Native communities. And then after that, share some information on the Native CDFI industry, what they are. And then we can get to our main topic so you can kind of understand why and how Native CDFIs assess risk using, for instance, character score. And then maybe we can end with some questions. So just some background on some of these disparities in any country. And I have a few here on this slide. So for instance, among heads of household in all Native geographies who self-identify as American Indian or Alaska Native alone, the median household income is about $42,364 compared to 55,478 in all Native geographies and 69,021 in the US as a whole. And then regarding the net worth, and I have you on the slide, the white to Native net worth gap, which is 32-1. How do we come up with that? Well, we draw on data collected by one Native CDFI located in South Dakota. And then our team estimates the median wealth or net worth to be roughly about 5,524, while the median net worth of a Black household, for instance, was 20,730, and the median net worth of a white household was 181,440, according to the survey that my colleague just talked about, the survey of consumer finance. So compare these numbers to those of white household in the survey on consumer finance imply that the white to Native net worth gap is 32-1. and a couple of other more. 30% of Native Americans live under the poverty line, and sometimes poverty rates on some reservations exceed 50%. And then 11% of American Indian or Alaska Native adults in all Native geographies have earned a bachelor's degree or higher, compared to 34% among all adults in the US. So with that kind of background, we can kind of see the impact it might have on access to credit. We all know that sustained economic development is to a large extent conditional on access to capital and credit. So Native communities have been deprived of such access historically. And I have here some barriers to access to capital. This first bullet is actually based on the survey of the FDIC, survey of household conducted by the FDIC. About 1 in 4 Native households were considered unbanked in 2021, compared with about 1 in 10 white households. And majority of Native American counties have fewer than 3 bank branches versus 26 on average for all counties. And the nearest bank branch about 12 miles from tribal headquarters. And then and the last item here that I have on the slide is actually taken from a study conducted by the Urban Institute. And you see on the chart that communities with a majority of Native American residents have the lowest median credit score. And then this is not too far from one of the slides that my colleague just showed. So these are the people Native CDFIs work with every day. And so what are they, these Native entities, Native CDFIs? So CDFI, as many of you already know, stands for Community Development Financial Institution. So I want to provide a bit more information on this industry and help you understand CRCD research agenda when it comes to Native CDFIs. Now, Native CDFIs are an increasingly important source of credit and financial services, and they can be for-profit, meaning banks or credit unions, or non-for-profit, or loan funds or community development loan funds, how they were called. But importantly, they have a social and educational rather than a for-profit only mission. So importantly, there's a lot of variation across Native CDFIs, of course, but one common thread is that they design the services with culture and relationships in mind. So despite their importance, unfortunately, up to now, there has been a relative lack of research documenting the work of Native CDFIs. So my co-authors and I are seeking to sort of fill the gap in the literature with ongoing research agenda that really seeks to better understand the operations of Native CDFIs. And toward the end, we are documenting, for instance, lending operations. We are studying how borrower and loan characteristics affect or predict loan performance. We also studying the link between financial training and loan performance. More recently, we've held listening sessions and interviews with about 46 CDFI, Native CDFIs. And we currently in the process of drafting a working paper based on what we heard during the interviews. And also we fielded a comprehensive quantitative survey to continue to increase our understanding of this industry. And we hope to report on that in 2024. So what do we know about the way Native CDFIs assess the client risk? I'm gonna use one particular research project to sort of illustrate that. So for this project, we rely on unique loan level data provided by some Native CDFIs. So I might say the data specifically were obtained by one nationwide Native CDFI called Oyster Corporation, and another consulting firm, Sweetgrass Consulting, who, with appropriate permission, share the data with our research team. And the data come from 11 CDFIs. And these CDFIs are representative in terms of loan products and portfolio size and loan disbursement. And they do represent a range of geographic regions. So, and they also represent in terms of lending volume 50% of the industry total. So yes, we don't have the entire universe of native CDFI loans in the data set, but we do have a relatively representative sample. And altogether, our data set includes more than 2,000 loans. And these are business loans, home loans, and other consumer loans. And these loans have closing date from, I would say, from 2003 to 2021, and the majority of which after 2015. And we also have in the data set the loans that are active, loans that are paid in full, and the loans that have been declared bad debt and written off. So that's a little bit about the data. Now let's get back to the risk assessment. So in our research, we addressed the question, what is the relationship between loan and client characteristic and delinquency? And we consider several different factors that may be predictive of the delinquency. So those factors do include, of course, credit score, household income. And in addition, we consider demographic variables like age, gender, and education. And importantly, in analysis, we also consider some of the what we call the innovative measures that are employed by native CDFIs. So these measures utilize community-specific knowledge and relationships. So these factors can include things like the character score. And what is the character score? A character score is a score assigned to the borrower based on a variety of factors, such as the role of the borrower in the community. Does the borrower have some strong support networks? What is the relationship of the borrower with the CDFI? And then also, what is the reputation of the borrower in the community? What is the overall financial literacy and the personal stability of the borrower? So as you can see, it's kind of interesting what they do. And then also we consider commitment to business, which is also another determination made by the CDFI about the borrower based on this community-specific knowledge and relationships. And then finally, we consider client engagement, which is a measure of how engaged the borrower is perceived to be by the native CDFI. And I do want to note that the character score and the commitment to business are measures that were pioneered by one distinct native CDFI from our data set, a CDFI called Forbearance Community Funds. So what are the takeaways? So these are some high-level takeaways from the delinquency analysis. First, our findings suggest that conventional measures of assessing risk are sometimes effective with these populations. So, and then we found that in most cases, credit score is negatively associated with delinquency. So just to give you a sense of how to interpret that finding, meaning the size of that effect. So if we look at all loan categories combined, 100-point increase in credit score reduces the probability of delinquency by 7%. Now, another commonly used measure of risk is household income. And in the context of consumer loans, we do find that household income is negatively associated with delinquency. So that means that borrowers who come from higher income households are less likely to have delinquent loans. And of course, that's not surprising to many of us. However, interestingly, that relationship does not hold for the other loan categories. So for instance, for business, home loans, household income is not a significant predictor of delinquency. So when we turn our focus to unconventional measures, we find again that these are sometimes effective in predicting risk. So in the case of business loans, we find that character score is strongly predictive of delinquency. Now, this means that borrowers who are perceived to be of higher character are less likely to have delinquent loans. And we might note that this is just identified of the data we got from forbearance, like I mentioned earlier. We also find that clients that are considered somewhat engaged are less likely to have delinquent loans than clients that are considered completely unengaged. However, we don't find any evidence of a relationship between commitment to business and delinquency. So let's kind of have a summary here. So one of our most interesting results is that in some cases, unconventional measures of risk may be more effective. Now, previously I said that credit score is predictive of delinquency. Well, this is kind of an interesting scenario. When we actually include both credit score and a character score in our analysis, well, character score is more predictive of delinquency than credit score. So in an analysis with both measures, credit score really does not provide additional information about risk. So our conclusion is what? That native CDFI practices around assessing client risk using character score is a very interesting process and probably costly too. And we don't really have details about costing, but our analysis suggests that lending models that incorporate borrowers' level information going beyond credit score and income may be well suited for native CDFIs because of the particular clientele that they have. And we find evidence that character-based and relationship-based lending might improve loan outcomes. Again, the million-dollar question is, well, how can these entities afford using these lending practices and at the same time continue to achieve a measure of operational efficiency? Well, definitely that warrants further research. And I think I'm going to stop there. And thanks for your attention. And I'm available for questions or comments about this interesting project.
Thank you, Mishu. And we have quite a few questions for you. Maybe a few clarifying ones on some of the information you shared. So real quick, do native CDFIs require the same credit score or history that non-native CDFIs, or is it just adjusted according to the number shown for native scores?
Well, the scores, now keep in mind that the scores were per loans in our data set. So these are native communities that come to these entities for loans, and then they just pull the credit score just using the same exact approach using Equifax, Experian or TransUnion or whatever. So they pull that and they collect that information. And also they collect information on other conventional measures such as household income. So the same score, credit score that everyone has, but based on the background information that I provided, it's fair to say that these are very low credit score. A lot of native folks are in what Ian called the thin file. So they either have very low score or the profile doesn't even exist at all.
Okay, thank you. And then you mentioned, I don't know if it was when you were talking about character score, but you used the term four bands or four brands.
Forband, yeah, Forband is the name of one of the native CDFIs in our data set. And then they have an interesting approach at tracking all this information. And then we found that particularly interesting because they have very detailed information on each borrower when it
Mhm.
comes to the character. And this is essentially based on how long they have been in community and how long they have been collecting this kind of information.
Okay. And when you're assessing the credit or the character score, I mean, who's doing that? Who determines that? And you mentioned that it had been more predictive than traditional credit score in this study. I mean, is the support just, what are all of the supporting components of that?
Yeah, good question. Now, the character score is assigned by the lender, so the loan officer, at the time of at the time they're putting together a loan package and before closing. And when I say character score was more supportive, I think you need to understand not only the background information that I provided earlier. So you have a borrower essentially in a thin file, though it doesn't have a high credit score, a very low credit score. And the chances are if that borrower were to go to a traditional bank and then pull through a traditional approach at assessing risk, chances are they might not get a loan. So I'm talking about integrating both the credit score and then the character score. And then, so what essentially this is saying, the character score is providing more information about the perceived risk when it comes to that particular borrower. So the credit score then is probably not meaningful, given the fact that it was already low, the person was already in a thin file. So the character score kind of dominates when it comes to assessing whether if I give a loan to this person, the loan is going to tank or not.
Okay. There's a lot of questions around the character score. What makes up the character score? Is fair lending considered in that? How is it objectively measured? Do you have answers to those?
Well, that's a very good question. When we started this project, we got the data from them, and then we pretty much, I don't want to say drill them, but we asked so many questions about the character score. And you have to understand that this is going to be very difficult for, let's say, another entity that is a non-native entity to sort of use, because it depends on a much deeper relationship that the entity has with the borrower. So your community. So basically, this is translating the power of knowing your client and relationship planning. You know your community, you know the person's reputation in the community. I talk about a support network. You have to know that, and this is going to be very difficult for a traditional lender to do in maybe a much more urban area, so to speak. So you have to know the network. And then in addition to all these little details about a person, of course, you have to include also the conventional measures that we're talking about, like the household income, and you have to also include the traditional credit score. So a whole host of information that you're tracking on just one person. Why? Because you are a mission-oriented organization, and you know that chances are that this person might not be able to, get a loan through the traditional approach.
Okay. And then an interesting question. Are there any initiatives in conjunction with this to help the communities that are being serviced also increase increase their traditional credit scores? Is there an education component combined with it?
Yes, that's a good question. So we had a parallel study that I didn't talk about to also assess the financial counseling that these entities offer. So we looked at the data obtained from one particular native CDFI about the amount of time that is spent with a client, either one-on-one or in a group setting, providing some training, financial training. And then trying to see if there's a way for us to sort of tell whether this is having an impact on loan performance. And then in our analysis, we found out that clients who are in a thin file and who have been able to get exposed to a minimum half an hour of training actually do see some impact on loan performance, which is kind of an indication of the importance of the financial counseling, meaning that in a way, the financial counseling is helping the lender as a substitute. A substitute may not be a good word, but it's helping the lender as an effective way of assessing whether or not if I, close this deal, this is gonna, turn into a bad loan. Now you have to keep in mind that even though they are, they have social missions. These organizations also do have fiduciary responsibilities. I mean, they're getting funding from maybe philanthropists. There might be some requirement related to these funding. So they have to make sure that they protect, the loans that they're giving out. So that's why they're going through all of these extra precautions, trying to make sure that, even though they're using character score and all of that, they're also administering the development service, which is the financial counseling program that they have.
That's great. There is another question, just a clarifying question. For the stat that 100 point increase only results in a 7% change in delinquency rates, is that an average across all scores or in a specific score range, like 520 versus 620?
So across all score, and so you have to see the data to see whether most of the loans, most of the client or recipients of the loan had what the average score. I don't remember exactly what the average score of loans in a data set, but that's across. So you have a combination of maybe a lot of some prime credit score or a lot of zero credit score and maybe a couple of high credit score, so you have that kind of combo. So that's why you can kind of see why the credit score didn't have a lot of power when trying to measure or predict loan behavior.
Okay. I don't know if we're going to be able to get to all of the questions in here. So I do want to just reiterate that or share that I will connect or provide links to the research that we're talking about today that maybe can dive in a little bit deeper and help answer some of these more technical questions for folks. I do want to invite Ing back just to make sure we get a few more questions directed her way as well.
Let me take off my slide.
Thank you. All right. So there's a lot of questions around using some of these alternative credit scores or credit scoring models. Is there any sort of data available yet? I don't know how long these have been available, but any data on how often people are requesting that, if businesses are starting to use that alternative scoring model instead? Do you have any data on that?
Yeah, no, I don't have any data in terms of like adoption of alternative credit score. Unfortunately, no. I don't have
Is
any.
it just still so new?
It's still relatively new. I guess like there are increasingly more like off-the-shelf alternative credit scoring models that lenders can use. But I think like initially it was more on the lenders would have to incorporate this data into their scoring models themselves. But now that there are more off-the-shelf kind of like scoring models, we may see more adoption, but I don't have any kind of data to speak to that.
Okay, because it's more so in the consumer's hands. They need to request that information be included.
Consumers have to opt in, and then there is certain regulatory uncertainties around like whether or not, like what kind of data can be used, and other kinds of like fair lending concerns and stuff like that, and compliance risks for lenders.
Mhm.
The adoption of like alternative data and as well as like machine learning it's more widespread among like fintech firms, yeah, compared to like mainstream lenders.
Okay. And so, again, to answer a lot of the questions in there about some of the technicalities of it, this is just, intended to share the research and what a CDFI is doing to utilize an alternative way. There's not a lot of data out there quite yet. Maybe we'll see a larger shift in utilizing this type of credit scoring. So hopefully there'll be some more information on that. I apologize we couldn't get to all of these, but I will do my best to connect people with resources. I'll utilize you, Ing and Mishu, to help make sure I'm providing the right information, and I'll get that out to everyone. Is there anything that you'd like to share with the group of bankers that we have with us today? Is any kind of closing remark on the research that you've provided?
No, I mean, I appreciate all the questions. I'm just getting a chance to read through some of the questions. I think these are some very good questions. And then, of course, many of the CFIs that we had in our data set, they're loan funds, so they're not regulated institutions. So I know a lot of the bankers on the call today, they have to abide by safety and soundness practices and so forth. So with the loan funds, they have the latitude of not having to do that, but at the same time, they're trying their best to make sure that they reduce to the strict minimum the default ratios, and therefore they are spending a lot of time. So it's very labor intensive, and the cost is really high. So that's why in my comment suggested that further research is conducted to sort of explore what is the optimum point for these institutions, how far should they go in incurring costs, trying to help the community as they trying to promote financial inclusion. So that's an important element that personally I'm interested in and would like to continue to explore.
Great, thank you. Well, I appreciate both of your time today to share the research on credit score inequity.